Statements of cash flows is a financial statement which concentrate on the changes of cash and cash equivalent during the period. There are three types of statements of cash flows: operating activities, investing activities, financing activities. The main revenue producing activities of the entity and other activities are not investing or financing activities, is the operating activities. And investing activities are the equation and disposal of long-term assets and the other investments not included in cash equivalents. Last but not least, financing activities are the activities that result in changes in the size and composition of contributed equity capital and borrowings of the entity. The purposes and uses of statement of cash flow prepared on cash basis and the accrual basis. It provides information on sources and uses of cash and cash equivalents, assesses liquidity and solvency, used by investors, creditors, shareholders, vendors, regulators, taxing entity, and more. Components and classification. Operating activities, income statement, current operating assets, and current operating liabilities. Investing activities, purchases and sales of non-current assets. Financing activities, cash inflows and outflows from non-current liabilities, creditors, and equity owners transactions. Significant non-cash investing and financing activities, material transaction not involving cash receipts or disbursements. Operating activities. Operating activities are all transactions and other events that are not financing or investing activities. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the entity. They generally result from transactions and the other events that enter into the determination of net income. The following are examples of cash inflows from operating activities. Cash receipts from the sale of goods and services, including collections of accounts receivable. Cash receipts from royalties, fees, commissions, trading debt securities, and other revenue. Cash received in the form of interest or dividends. The following are examples of cash outflows from operating activities. Cash payments to suppliers for goods and services. Cash payments to employees. Cash payments to government for taxes, duties, fines, and other fees or penalties. Payments of interest on debt. Indirect method of presenting operating cash flows. Under the indirect method, also called the reconciliation method, the net cash flow from operating activities is determined by adjusting the net income of a business for the effect of the following. Non-cash revenue and expenses that were included in net income, such as depreciation and amortization expenses, impairment losses, undistributed earnings of equity method investments, and amortization of discount or premium on bonds. Items included in net income whose cash effect related to investing or financing cash flows, such as gains or losses on sales of property and equipment, related to investing activities, and gain or losses on extinguishment of debt related to financing activities, or deferrals of past operating cash flows, such as changes during the period in inventory and deferred income, or accruals of expected future operating cash flows, such as changes during the period in accounts receivable and accounts payable. Increase in current operating liabilities will be added to net income. Decrease in current operating assets. Decrease in current operating assets will be added to net income. But increase in the current operating assets or decrease in the current operating liability will be subtracted from the net income. Non-cash losses and expenses included in net, and losses and expenses whose cash effects are related to investing or financing cash flows, both will be added to net income. Non-cash gains and revenues included in net, and gains and revenues whose cash effects are related to investing or financing cash flows, both are subtracted from the net income. As you can see on the screen, there are two tables demonstrating for direct method and indirect method for the statement of cash flow for operating activities. About investing activities. Cash flows from investing activities represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. The following are examples of cash outflow and inflows from investing activities. Cash payments to acquire, cash receipts from sale of property, plant, and equipment, intangible assets, and other long-lived assets. Cash payments to acquire, cash receipts from sale and maturity of equity and debt instruments, such as the held-to-maturity securities and available for sale debt securities of other entities for investing purposes. Cash advancements, cash advances and loans made to other parties, cash receipts from repayment of advances and loans made to other parties. About the financing activities, cash flows from financing activities generally involve the cash effects of transactions and other events that related to the issuance, settlement, and the reacquisition of the entity's debt and equity instrument. The following are examples of cash inflows from financing activity. Cash proceeds from issuing shares and other equity instruments, obtaining resources from owners. Cash proceeds from issuing loans, notes, bonds, and other short-term and long-term borrowings. The following are examples of cash outflow from financing activities. Cash repayments of amounts borrowed, payments of cash dividends, cash payments to acquire or redeem the entity-owned share, cash payments by lessee for a reduction of the outstanding liability relating to the finance lease. Major statement of cash flow notes disclosure. Information about all non-cash investing and financing activities. Investing and financing activities that affect recognized assets or liabilities but not cash flows must be disclosed in the notes. The following are examples of non-cash investing and financing activities. Conversion of debt to equity. Acquisition of assets either by assuming directly related liabilities or by lessee's recognition of a finance or operating lease. Exchange of non-cash assets or a liability for another. And as you can see on the table, is a example summary of cash flow statement of a company. We will combine the net cash provided by operating activities and investing activities and financing activities to get the net decrease or increase in cash and cash equivalents during the year. And then we will combine with the cash and cash equivalents at the beginning of the year to get the cash and cash equivalents at the end of the year. There are also some questions, small questions, interactive questions for you. The first is, which of the following items appear in the company statement of cash flows? Surplus on revaluation of non-current assets, proceeds of issue of shares, proposed dividend, irrecoverable debts written off, dividends received, and only two of the four items here satisfy the required of the question. It is a process of issue of shares and the dividends received. The second interactive question, which of the following items could appear in a company statement of cash outflows? Proposed dividends, rights issue of shares, bonus issue of shares, and repayments of loan. It is a rise, issue of shares, and repayments of loan are the cash flow. Yeah. The limitations. Cash basis does not match accrual basis recognition of revenues and expenses. Management decisions may not be fully reflected. Issuing debt reflected as a cash inflow does not represent future costs. Buying equipment reflected as a cash outflow does not represent future benefit. Inputs, income statement, net income, non-cash items, depreciation and amortization, gains and losses from investing. Statements of changes in stockholders' equity, dividends of the equity transactions, comparative balance sheet, changes in balance sheet accounts, footnotes, information on material non-cash transaction. We got some more interactive question. Part of the process of preparing a company statement of cash flow is a calculation of cash inflow from operating activities. Which of the following statements about that calculation using the indirect method are correct? Loss or sale of non-current assets should be deducted from profit before interest and tax. Increase in inventory should be deducted from profit before interest and tax. Increase in payables should be added to profit before interest and tax. Depreciation charges should be added to profit before interest and tax. 2, 3, and 4 are right. And now, one more question. An extract from a statement of cash flows prepared by a trainee accountant is shown below. Cash flows from operating activities. We will start from net profit before taxation, adjustment for depreciation, then we will get the operating profit before working capital changes, and we will add the decrease in inventories, minus the increase in receivable, minus the increase in payables, and then we get the cash generated from operation. So now the question is, which two of the following criticisms of this extract are correct? The first is depreciation charges should have been added, not deducted. B, decrease in inventory should have been deducted, not added. C, increase in receivables should be added, not deducted. And D, increase in payables should be added, not deducted. And the first and the fourth item, A and D, are correct here. Cash flows from investing activities. Purchases, outflows, and sales, inflows of non-current assets, including property, plant, and equipment. Trading securities, classified as non-current. Available for sale securities, held to maturity security, and acquisitions of other entities. Cash flows from financing activities, issuance inflows, and repurchase, pay down outflows of non-current liabilities and equity, including stock, bonds, long-term notes payable, and payment of